Welcome back, everyone. Thanks for joining. Today on the Joseph Carlson Show, we're going to be going over how animal spirits have taken over the stock market. Of course, animal spirits refers to the emotions of greed and fear, of herd mentality, of investors now banding together and racing into this stock and that stock. The stock market in and of itself is evidence that animal spirits are now playing a role. In fact, just this year, the S&P 500 is up around 27%. If we look right now, it's up a little bit above 27%. The QQQ is right around the same, up 27%. Dan Ives, who is one of the most followed analysts on Wall Street, just recently said that Tesla, which trades at an above 100 PE ratio, is the most undervalued AI name. Not the most overvalued, but it's the most undervalued AI name. Tom Lee, one of the most followed analysts on Wall Street and commentators, said that there's really nothing to worry about over the next 12 months. We have these analysts going on, more and more of them giving more and more bullish takes. At the same time, we see lots of evidence across social media with YouTube personalities creating things like stocks that will get you rich in 2025. These are now receiving hundreds of thousands of views. We're going to be going over all of this. What do we do in a stock market where animal spirits have taken over, where herd mentality plays the biggest role, where prices are high and the only person not buying is Warren Buffett? We'll be discussing what I'm doing in this episode. Now, of course, we have some other news to get to. We had big news that Terry Smith of Fundsmith released his fact sheet that he does every month, and he sold one of his largest positions, a very notable company. We'll be looking at what he sold in this episode. We also have news that Pat Gelsinger of Intel, the CEO of it, just stepped out. We don't know if he was fired or if he willingly stepped down, but either way, he's out of Intel. We'll be taking a look at his troubled tenure, what happened with Intel, and if a new CEO can really fix these problems. Then finally, we had some good news for Disney. They had Moana 2 come out, one of the most anticipated movies, and it made $221 million in its opening 5 days. This is one of the biggest openings for Disney ever. So we'll be looking at how this impacts Disney, the fact that they're now making these big box office movies again. And then finally, we're going to be looking at a report that the Wall Street Journal released that Googling is for old people. We'll be going through that as well in this episode. So we have a lot to get to in this episode. Before we jump in, just one quick mention. We finally got to the beginning of December, which means that if you try out the Joseph Carlson Show Patreon, now you get the entire month of December as a free trial if you've never tried it out before. The reason that I mention this is because the Patreon now has over 7,000 members. A lot of people really like it and enjoy it and use it every single month. The Patreon comes with Qualtrim.com. This is a website that I own 100% of. I created it myself. I created it specifically for you, the investor. It's something that I've literally tailor-made. I've looked over all the different data it provides, all the different decisions that we do to make it the most fast-running, the most easy place to research stocks. You can look up anything and it loads incredibly fast. I can look at Costco. 2 seconds, the page is loaded. I have all of Costco's data. There's virtually no load time on any page. There's a powerful watch list page where I can look at my restaurant watch list, and I can look at all the different companies that are restaurants trading in a dip or having price momentum. It has full earnings call transcripts. It has a full 5-day week earnings calendar, which you can see upcoming earnings and see their historical performance, whether they outperformed or underperformed, and so on and so forth. And we're always making additions and improvements to that as well. And again, Qualtrim is included fully as part of the Patreon. It's at no additional cost, as well as exclusive episodes and a Discord community. So try it out now if you haven't already. Now, as we jump into the main story, I think it's first important to define what animal spirits are. In finances, animal spirits is a term to describe when emotion starts to take over investors' decisions. Broad and wide, that's what's happening right now. The emotions of fear and greed, herd mentality, or FOMO, the fear of missing out on the latest stock or the latest trend, start to take precedent over well-grounded assumptions of the future. Investors that are grounded to expectations of cash flows and business performance. And I've seen that happen in this market. Now, animal spirits can happen on either end of the spectrum. It can happen when we're at extreme lows and it seems like we can only go lower. You'll have people talking about calamity and how the world is ending, how everything is getting worse when we're at the very bottom. We also have at the other end of the spectrum, where I think we are closer to now, where prices are generally high. Stock multiples are expanding. Things are getting more expensive, but investors remain bullish. They find reasons to jump into even more expensive stocks, believing that they'll go up even further. They rationalize and justify reasons that stocks will continue to go up for long periods of time into the future. There almost seems like there's no problems, no challenges. And instead of looking at valuations, and cash flows of the future, investors gravitate to narratives and stories. What we see now is evidence that animal spirits have taken back over this market, and I see it in a lot of different categories. For one example, we see it across social media. On Twitter or X, we have post after post of people saying that this is the next Amazon, that this $100 billion company is going to be worth trillions and trillions in the future. On YouTube, we have people talking about the next 3 stocks to get rich in 2025. Become a millionaire with this stock. Get rich, make money with this stock. We have excitement and exuberance all across social media. And then we even see it going on to CNBC. For example, one of the recent appearances from Dan Ives, who is one of the most closely followed investors on social media, is him saying that Tesla, of all companies, that Tesla is the current most undervalued AI name in the market. Let's go ahead and take a listen.
Do you buy Tesla here then, given the rally we've seen, the torrid rally we've seen this month?
I think get the popcorn out.
When asked if we should buy Tesla here, after the valuation has increased dramatically, after a torrid rally, after the company now trades at $1 trillion market cap, his answer is to first get the popcorn out, as he leads into the rest of his answer.
Because I believe Tesla's a stock that could ultimately double from here over the next 18 months. It's been obviously a parabolic move, but as me and you have talked about, autonomous itself, we think is worth $1 trillion. So when you think today, I view Tesla as the most undervalued AI name in the market. It is not ridiculous. It might almost be conservative to think, could this be a $500-600 stock? As the autonomous ultimately plays out, I think the margin story is definitely stabilized here. And I think investors, look, the haters continue to hate. They hate it at $50, they'll hate it here. But I think we sit here, and this will be sort of a golden star, in terms of when you look at the market in 2025, in terms of what we see for Tesla. I believe $2 trillion on the horizon.
We should first get the popcorn out because Tesla is going to double over the next 18 months. And in fact, when he looks at this over the long term, Tesla is the most undervalued company because of robotaxi, because of autonomous vehicle. That in and of itself, according to Dan Ives, is worth $1 trillion. So Tesla is roughly half the way there once they get the robotaxi going. He's also quick to dismiss anyone that's skeptical of Tesla's current valuation or the narrative of their robotaxi value creation in doubling the stock. Anyone that doesn't believe this is simply a hater. They've always hated the stock. They haven't kept the faith. They don't believe in Tesla. They're going to hate it in the past. They're going to hate it in the future. They're just haters and they should be dismissed. The people that have unbiased views on Tesla are the people that are bullish on the stock. According to Dan Ives, that's the way that he views it. Now, if we look at Tesla today, the stock is up another 3.15% on its long march to $400 per share. We have notes here from Qualtrim that Tesla shares are trading higher after Roth MKM upgraded the stock from neutral to a buy and raised the price target from $85 to $380. These are the type of changes we're seeing in companies like Tesla. The market cap of Tesla is now $1.14 trillion. Now you may look at that and say it's just a little bit above $1 trillion, only $1.14 trillion. So you might even round off the $140 billion. But if we look at just that $140 billion alone, and we compare that to Uber, a company that's similar in a lot of ways to what Tesla's trying to do, Uber is the largest taxi network in the world. It's not identical to a robotaxi because most Ubers have drivers in them, but regardless, the economics are pretty good for Uber because they don't have to pay for the vehicles. So Uber operates this massive network. Uber has, over the past trailing 12 months, 161 million people using their platform. These are people that are active every single month, at least once a month, ordering Ubers or ordering Uber Eats or last mile delivery. They're in one way or another using this network. That's 161 million every month. In the past trailing 12 months, Uber has completed a staggering 10.81 billion trips, billion with a B. So over 10 billion trips, 161 million users. This company's total value, the entire company is worth $154 billion. When comparing the total market cap of Uber for Tesla, it's a rounding error for the stock. 1.14, that 14 is Uber. So Dan Ives is arguing that Tesla's robotaxi network someday in the future is worth arguably 8 to 10 times what Uber is worth. And Uber, which is already an established business, having 186 million users and completing 10.5 billion rides in the past 12 months. Now, you may argue that Dan Ives has been right on Tesla so far, but if you take a closer look at his history in rating Tesla stock, he has been a little bit optimistic at times. We have here a Tesla price target from 2021 where Dan Ives boosted his price target to $1,400 in 2021. Now, of course, Tesla has gone through a 3-to-1 stock split, but even if we factor in that stock split into this price target, it would be as if he gave the price target of $467. And again, this was back in 2021. This was almost 5 years ago. And so far, Tesla now today trades at $356 even after this monstrous rally. Is his new price target of Tesla doubling over the next 12 months a bit optimistic? Can Tesla maintain these values in the future? Or will Tesla investors have to wait for another half a decade if this market cools off? Bull markets are an interesting thing, where any type of skepticism or conservatism gets clouded out by exuberance and optimism. It's a point where investors no longer want to pay attention to anyone that has any type of caution for investing. They want to listen to the people that are continually bullish, and you'll notice this in the numbers. For example, Tom Lee, a notable bull over the past couple of years, has gained increasing popularity almost every single appearance on CNBC, with the numbers going up from 20,000 views to 50,000, to the point where now every single appearance he has on CNBC, he gets 100,000 plus views, and he has more and more frequent appearances over time. This is the virtuous cycle of a bull market. The most notable, optimistic bulls get the most views. It gets the most views, so they have them on more and more frequently. And here we have Tom Lee himself, once again, giving a bullish outlook for the future, saying that we don't have too much to worry about.
It's a great question because, we have 2 back-to-back 20% years, and now investors are wondering how much good news is baked in. But if we look at the 2025 environment, it's a great setup because we have a new administration coming in that's maybe pro-animal spirits, a Trump put.
He actually mentions animal spirits in his commentary of why the market's going to do well over the next year.
Dovish Fed, and as you're pointing out, interest rates are kind of calming down after rising, and we know there's still $7 trillion of cash on the sidelines, and I think sentiment's coming back into check. You mentioned that before with the AAII numbers, so I think it's a good setup for investors. I wouldn't be too worried about the next 12 months.
Now, everything Tom Lee said is true. The setup looks really good for 2025. It looks like the coast is clear. But when investors are repeatedly told that everything's good in the market, that they can't lose, there's really no downside, nothing to worry about for the next 12 months, that you should be seeking out the most aggressive, the most risk-on companies, or you might miss out on gains, that inevitably leads to behaviors that end up in disaster. Now, there is still one investor or market commentator that's willing to point this out, that higher valuations leads to lower future expected returns. The companies are still based on their future cash flows. The piling into the most momentum picks in the market is a dangerous strategy, especially after the market has already raced up to higher and higher valuations. Howard Marks recently sat down with Bloomberg and I believe gave the best explanation of how investors should handle and behave in a market like this and how they should position their portfolios.
But Warren Buffett has taken money off the table, more than $300 billion worth.
Why?
No, he says there's nothing to buy.
Well,
valuations are high.
But what percentage? People look and they say, well, Buffett sold some stocks. Does that mean we should get out? What percentage of his stocks did he sell? Probably rather small. So it's not a broad statement. If it's a little high, and I say be less aggressive. If you want to sell 2 or 3% of your stocks, I understand. But Buffett's not selling all his stocks, and neither, I think, should anybody else.
His first instruction is that even though we may recognize that the market is very bullish, it's being ran by animal spirits, there's momentum carrying the market, and things are, in his words, a little expensive, that doesn't mean we should get out of this market. And even when he's countered with the example of Buffett, raising so much cash and selling so many stocks, he says even with Buffett's example, we still shouldn't get out of the market. Buffett himself has most of his money in the market. He has a higher percentage of cash than he has historically, so he's a little bit more conservative postured, but Buffett has many companies that he's fully invested in still in this market. Buffett still hasn't sold everything. He's not moved fully to cash. And Howard Marks doesn't think investors should either.
Howard, you talk about how you hate making calls,
Right.
Predictions, estimates, but Goldman came out to say that it sees a further 10% upside in the S&P
Yes.
from now through the end of 2025.
Yes.
Is Goldman right?
10.
10.
Well, that's pretty good, isn't it? On the other hand, Goldman, I think, is fair to say, put out a report 3 or 4 weeks ago in which they said that the PE ratio on the S&P 500 is high. So as opposed to 10% average return over the last century, they're projecting 3% for the next decade. So that's rather cautionary. It's not get out, it's not sell, but it's moderate your expectations. On the other hand, a 10% gain between now and the end of 25 would be quite nice. So I think what this shows, Haslinda, is that investing in the short run is very uncertain, and nobody should think they really know what's coming. And most people should take an almost passive approach. The idea is it's good to invest. It's good to invest in the United States. It's good to invest over time. And it's bad to try to mastermind it in the short run with get in, get out.
Seasoned investors like Howard Marks know better than to try to play the game of timing the market. And his instruction, no matter what market we're in, is to not try to time it, even if things look very expensive. But he also warns that as prices go up, it's not a time to become more and more aggressive. It's not a time to become less and less strict with your investment criteria. In fact, quite the opposite. As prices and valuations are increasing, it's time to become more conservative, a little bit more cautious.
Investing is a good thing. Do it early, do it a lot, so that you can build the nest egg. Don't screw it up.
Getting out of the market is a bad idea, and that's why I stay fully invested virtually all the time. I have both of my portfolios working in these stocks almost all the time. I only trade a little bit. I've only done a few trades this year as I've felt like I've optimized my portfolio over time with companies I really like. And I've done the same thing that Howard Marks is saying, to stay invested. But as the gains have grown in my portfolio and valuations have gotten a bit higher with many of the companies that I've owned, I agree with Howard Marks. It's time to not screw things up. So hopefully as we go into 2025, we can have it a year where we don't screw it up. Now let's go ahead and get into some headlines here. Now the first story here is that Terry Smith of Fundsmith had a major sale in his portfolio. He has this fund fact sheet where they give a little bit of data every single month about their trades and what they're doing. And one of the portfolio changes was that he sold, let's take a look at it here. We exited our position in Apple during this month. So November of 2024, they sold completely out of Apple. Now, we don't have, as of yet, any type of commentary or explanation of why he sold the company. We just know that they did sell it. And overall, I agree with this decision. I think that Apple has been a great position for the past couple of years. It's one that I've been invested in as well. I still hold Apple as a half-size position with $30,000 invested in it, but I've been selling my position, trimming it over and over and over again all throughout 2024. And eventually, this could be a position that I work my way down on to completely sell out of. Right now, it's been a big winner in the portfolio. $33,000 of gains. It's paid dividends. It's done buybacks. It's grown tremendously over the past 5 years. But every company has a true narrative, events that will occur. With Apple, the main reason that I invested in this company was the narrative of it transforming from a hardware company to a subscription software company. Now that they've made that transformation, they're finding it increasingly difficult to grow from here. So Terry Smith has done a lot of sales I don't agree with. This is one that I do. Now we also have news that Pat Gelsinger, the CEO of Intel, is out. He's the CEO no more. Pat Gelsinger was advertised as the guy that could fix these issues and make Intel once again competitive with these other companies. He planned aggressive efforts to close the technology gap and expand Intel's network of chip plants while also building the so-called foundry business manufacturing chips for other companies. He quickly hit challenges. The pandemic-era PC buying faded with the return of regular work patterns. Intel largely missed out on the new computing revolution, chips that power AI. Intel also had slower than expected sales. They didn't reach their $500 million sales target. And analysts on the most recent call grilled him about the progress of the company's contract chip-making business, which has struggled to attract big customers and has cycled through several leaders. And these problems continue on. They didn't get as much money as they thought from the CHIPS Act. They had to lay off 15,000 employees. And overall, if we look at the fundamentals of Intel, the company is in bad shape. We look at a company that has declining revenues. Revenues going from $79 billion down to $54 billion, and cash flows that have steadily been in the red since 2022. Now, I'm a believer that good leadership really can change around companies. If you have the right person that knows how to put in the right team, that knows how to still the right talent to work for a company, to gain the contracts and the sales funnels, there is someone that can change around a company like Intel and get this thing back on track. But that's a very risky game, in my opinion. To invest in a company that has a very complex business model, lots of working parts, lots of things that can go wrong, and to hope that a leader can turn it around. Intel's in a highly competitive, operationally complex business. Turning it around is going to be a challenge. This is a stock that so far I continue to avoid. Now we finally have some good news for companies. Moana 2 snares $221 million in its 5-day domestic opening. Now Moana 2 was the most successful over the weekend, so good job Disney on that, but they weren't the only ones seeing a lot of success in the box office. Disney's Moana 2, Universal's Wicked, and Paramount Global's Gladiator 2 pushed the 5-day Thanksgiving holiday to its biggest haul in cinematic history, an estimated $420 million in sales as of Sunday. Part of it was the diversity of these movies. It was a perfect storm of Thanksgiving box office, powered by a trio of films from musicals, epic dramas, and family film genres. So all of these have different broad appeal to different people, so all of them got a lot of viewage on the same weekend. It was pretty amazing how that actually worked out for the box office. And again, Moana 2 led the frame with $221 million for the 5 days. It was the winner, and analysts were only expecting $100 million in the box office. Now, I saw Moana 2. It was good. I thought it was a good sequel. It wasn't as good as the first, but the kids liked it. But either way, Moana 2 doubled what the analysts had projected over the weekend. Over doubled it, in fact. This shows that there's still enormous demand for the box office, for people to go out and have experiences in movie theaters. Movie theaters still are in demand. And that was something that was questioned over the past 5 years. Are people only going to want to watch things on Netflix or Hulu? That's not the case. People still want to go out to the movies. And that speaks very well for Disney. If Disney can get back into the rhythm, which I believe they are, of creating these drumbeat successes that make hundreds of millions of dollars in the box office, their free cash flow in 2025 is going to be above analysts' expectations. So as we go into 2025, I look at Disney's valuation with a high free cash flow yield, a low PE ratio. I also look at the growth in their Disney Plus, and I look at the success in their box office, and I believe that this could be a good bet for 2025. It's not one that I'm currently invested in. I still hold Netflix, and I think that's going to be the biggest winner in media, but I think Disney's on track to have a pretty good year. Now finally, we get to more headline news that there's more bearish articles on Google. The latest one is from the Wall Street Journal. Googling is for old people. That is a problem for Google. They first say that the trends moving against Google are so numerous and interrelated that the DOJ's attempt to dismantle the company could be the least of its problems. The company's core business is under siege. People are increasingly getting answers from artificial intelligence. Younger generations are using other platforms to gather information, and the quality of the results delivered by its search engine is deteriorating as the web is flooded with AI-generated content. Taken together, these forces could lead to the long-term decline of Google's search traffic and the outsized profits generated from it, which prop up its parent company. They highlight that the first danger facing Google is clear and present. When people search for information or they go shopping on the internet, they're increasingly shifting to Google's competitors. And eMarketer is projecting that Google's share is going to be below 50% next year. So you can see right now the projections of it. Right now, Google's right there at 50.5%. It's going to go down to 48.3% in 2025. Google themselves has admitted that they face competition. Quote, "Evidence at the trial shows that we face fierce competition from a broad range of competitors." Google's trying to prove that they're not a monopoly by saying that we face competition. The reason that Google's losing so much search advertising dollar market share is not really because Google searches are going down so much. It's because Amazon's growing, and it's growing quickly with its advertising search dollars. The majority of their advertising revenue comes from their search. When you search a product in Amazon, you'll get sponsored listings. Those are companies that pay to get their product in front of you, believing that you'll like it. So when you have a search in Amazon, they're paying for those product listings. Many people pay for those promoted products. Then you get the advertising dollars going up. As Amazon continues to sell more and more items every single year, as online retail takes a greater and greater market share of retail in general, advertising continues to climb at a rate of 19% year over year, which is much faster than Google is growing. So advertising on Amazon is growing like a weed, and therefore it's taking market share from someone else. That someone else is Google. So when I look at this, I see this as more of Amazon growing their business than Google's business in decline. Now, the second threat that they highlight are the rise of alternative search engines that are answer engines, like Perplexity, ChatGPT, and other platforms like Meta have reports that they're exploring building their own search engine. So it seems like now everyone wants to get into the AI search engine game, and that will be more pressure on Google to hold their market share. And this gets even worse. One analyst says that Google had this seemingly insurmountable position in search until AI came around. And now AI is to search what e-commerce was to Walmart. So we're seeing a massive challenge to their core business and the moneymaker for Google. So there we have it, more and more negative media attention around Google. You have the pile-on effect on this stock. The real gains in the market come from buying quality companies, great companies, when they're on a dip, when they're selling for cheap prices. The problem is, usually when companies are good companies and they're selling for cheap prices, there's some type of negative story. There's some type of negative sentiment built into the stock. And that sentiment can be very difficult to wrap your head around. We saw the same negative sentiment in Amazon in 2022 when the stock price was $80 a share. It was a money-losing retailer, low-margin business being beaten by Temu and Shein. We saw the same thing with Netflix in 2021 and 2022. It was a company that was being clouded out by competition. The story was completely dead for Netflix. Everybody was selling the stock. This is the type of times where you want to get into a company. I can't say whether or not Google will overcome these challenges. Every time the future is unknowable, but right now I do see a very high quality company facing a plethora of different challenges and questions to its narrative, which has caused the stock price to go rather low. So I'm currently buying in the company. I think this could be another time period where things aren't quite as bad as it seems. And as far as I'm concerned with Google, even if this company doesn't work out, even if it doesn't do well over the next couple of years, I don't believe it will be one where I lose a bunch of money. The stock is trading at such a low valuation, it already has so much pessimism priced into it, that it's difficult to see a company of this quality going much lower. So I'm still making a bet on this one. We'll see how it works out in the future. But these articles and continual bearish sentiment make me more excited about Google. That's all for this episode. See you in the next one.